ICT and SMC are useless if you don't understand how to form a bias. Order blocks, fair value gaps, all of this is completely worthless if you cannot form a bias. There's little content out there that will actually teach you step by step how to find a bias. So in this video, I'm gonna go step by step and show you my process that I use to get funded with 300K. Make sure you pay attention to the end, put your phone aside, and really devote your full attention if you wanna get the most out of this. Let's go ahead and get into it. For a lot of you, daily bias is the last piece of the puzzle for you to master SMC and really start to be consistent. So please put your phone away, pay attention to the end of the video, and I promise you, you're gonna walk away understanding it much better than you did before. Daily bias is something that it really needs to be simplified because there's very few videos, even found within the core content, that are directed towards teaching you daily bias step by step. You'll learn it over time, bits and pieces. Like I did, it took me a long time and then it clicked, but it doesn't have to be like that. So I want to go over step by step the way that I look at daily bias, and it may be different than what you've taught. Let me know in the comments if you have a better way. So what is daily bias? Daily bias is directional bias. Are we bullish or are we bearish? And for daily bias, it means for the day at hand. If you're a day trader, this is really important to understand for obvious reasons. If you want to trade, you need to know which way the market's going. And you don't always have to trade with the market, but if you're trading against it, you damn sure need to be aware of that. A major part of understanding bias is understanding that we are simply finding our target, also referred to as our draw on liquidity. What is price reaching for and why? And last but not least, we have low-hanging fruit, which was, for me, one of the most important concepts that I had to grasp before I became consistently profitable. Everybody wants to swing for the fences all the time, and sometimes you'll get those opportunities, but chipping away and securing money based off of targeting low-hanging fruit is going to help you a ton. While a lot of ICT is discretionary, I like to have a mechanical process. So here's my 3-step process for finding bias. We're going to break down daily bias into 3 key pillars, and that is structure, liquidity, and order flow. We're going to go ahead and get started with structure because structure is king in all of smart money. So if we're looking at price, we're going to use structure to map what liquidity to look for. So if we are bullish and the market is moving up, well, the expectation is that we're going to continue to move up. So if we come down into the lower part of the swing, we can target that high because that's the expectation that the market is going to continue. But just because the market is bullish doesn't mean we're always going to be able to just take longs. Of course, we're going to see retracements down into a discount, which is under 50% of the leg that we just saw. If we have this leg in price and we come back down under this midpoint, well, price would be at a discount compared to this range. Now, if we're up here, just because we're bullish doesn't mean we want to long. We're going to use our premium and discount plus structure to tell us, are we bullish or bearish? So we can have a bullish structure and have an expectation to move up, but in order to go up, we have to come down. So we're going to use premium and discount to help us with that. As we all know, all trends come to an end. So this expectational order flow is only going to work if we see displacement. I cannot stress this next part, how important it is. This is what changed my trading, and you have to understand what displacement is and require it in your trading. So let's say the market continues up, and then we start to get this lackluster move, and we barely get a tiny little move above this, and then a big push down, breaking structure like that. Well, if we pair this with the higher time frames, maybe we had came into some form of area of interest on a higher time frame, and that makes it more likely that we're going to pull back. So we're not going to continue to look for buys. If we don't have displacement above an old high, we look for new lows. If we have a pattern like this, when price comes down into the discounted range, we're going to look for a higher high because we had displacement above an old high. That tells us price is reaching upwards towards something above. If we have something like this, where price comes down and then it's barely making a move and we barely come above these areas, maybe equal highs or maybe just a regular high, and then you see a massive push down, then we're probably going to see a new low. This is where a lot of people get messed up and they'll just try to be robotic about structure and say, oh, well, we made a higher high, so we're bullish. I'm going to long here, and that's just not how it works. It comes out, takes out traders. So when we're trading smart money, we're always trading with the idea of manipulation in mind. So if we are looking for a indication that our structure is correct, we want to see displacement, because if we're seeing these big energetic pushes up in the market, then we know that they're sponsored by big forces, because it takes a lot of money to cause a massive move. So what are some ways you can try to make displacement mechanical? Number one is candle closes. Now, even if you have a candle close just above this high and it's barely above it, that's where a lot of people will get messed up there. Displacement is discretionary, but I think it's undeniable in its own way. Let's take a look at a chart really quick. So if we look down here, when we came under this low, we really have a forceful push. For instance, when we look at structure over here, this is a big push. That is displacement. That is an energetic move down. We know that there were large players behind that move. So that's the true direction of the market at that time. Now, if we look at this down here, we barely came under here, took the stops, and then what happened? We took out this high. And look how we took out this high. We did it with force, so when price came back down, it then went back up to take out a high again. So if you're looking at price and we have a clear area where we know that we took stops and then we came up, made a displacement leg, we know that we can look for price to come back down to a discount, barely tapped it, and then we're going to make new highs. So if you're right here on the daily chart, you know that you're going to be bullish. Now, if we look here, we had 1, 2, 3, 4, 5 total days before that happened. And 4 out of those 5 days, you saw upwards movement. So if you look for a long and you had your entry model provided, 4 out of 5 days you won. If we look at price over here more recently, price is reaching up. We made a new high right here. Price is coming down. And now I want you to pay attention closer to this. See how he came up, we made a high, a low, displacement, protected that. Then price did what? Price did make a new high, but look at this move right here. Does this look energetic like something like this? Absolutely not. And what happens? Price reverses. So this is an example of no displacement. So just because we got a wick above doesn't mean that you're going to use structure to say we're bullish and that we are to continue going up. This is a good example of displacement. So again, I cannot stress how important displacement is. If no displacement holds through structure, expect a reversal. This can give you a change in bias. Or if displacement pushes through structure, price is reaching. So that leads us into our second pillar, because if we've established, okay, is price reversing or is it reaching towards something? If it's reversing, you have the recent lows. For instance, like we went over that example, let's say you barely get a move here, well, and you have a big wick, this is going to be your target. That's an easy low-hanging fruit draw on liquidity, and you can target that. So you can be bearish until you hit that. But on the flip side, if price is reaching and we have displacement, what is it reaching for? So this is where liquidity comes into play. So liquidity is going to help us with our targeting and help us with the why, because the structure is telling us where price is going. If structure is displacing towards something, it's moving towards an area of liquidity. That's why they call it draw on liquidity. So you can think of it as a magnet, and price is showing you desire to move towards this magnet. And as it gets closer and closer to it, the push towards it is going to be even stronger. Now, each time a draw on liquidity is met, you can expect a reversal. But again, we're going to use structure to confirm that. So if I don't get displacement or I don't get signs of a reversal, I'm not just going to look for a reversal as soon as we hit a draw on liquidity. That is another common mistake I see people doing, is they'll target one area, it hits that, and then now they're just going to target the opposite liquidity. And sometimes you're wrong, and maybe price was reaching higher than you thought. So you need to use structure. Structure is paramount. Something you need to remember is that structure is always reaching for liquidity. So what is liquidity? Well, we're looking for areas where stop losses or other orders might be. So we're going to be using structure or imbalances. So if we have the market and price has made a pretty clean bottom right here, we know there's going to be a lot of people stopped out. So let's say price moves up and then we get a displacement down. That structure is going to tell us we're reaching for something. Now, if we're looking at this chart, where is the most obvious place that stop losses are going to be? Well, we know that under all of these lows, a lot of traders are going to get stopped out. So if you have a pattern like this, you can use premium and discount. So maybe you came down right here and you took out this low, and then the lower time frames are telling you that price is reaching up. Well, the daily is telling you that that would make sense because we need to go back into a premium. So then you might be bullish until we get to that premium, but then you're trading in the context that the whole why is we're going on this low. The only reason we're pushing up here is to go down. So you can be bullish on the way up, and then you get displacement out of there, and then now you are full bearish mode. You've got that confirmation, and now you're just going to trade bearish all the way into your draw on liquidity. Now you can expect a possible reversal there, but we're not going to force that until we get what? So as structure comes out of there with displacement, we then say price is reaching up. Where is it reaching up? Maybe there is an imbalance here with a high front running it. So you'd say, okay, I'm going to wait for the lower time frames to give me this kind of price action to tell me, let's say if you're looking at, here's the view on the daily, and then we're going to zoom in, and here's your view on the 1 hour, and you get this pattern, right? That bearish push down, push back, and then you're starting to go down. That could tell you that price is going to go down to a discount. So let's say you get that pattern, you're bearish till you get into a discount, right? Maybe you're targeting an imbalance here. Maybe there's a set of lows on the lower time frames, whatever it is. And then you're going to be bullish. Now, what would be the low-hanging fruit in this example? This high, just the next structure, because again, your displacement told you you're going to go up, but now you're using liquidity to say, well, where are we really going? So that's your low-hanging fruit, but you can target this high and then this imbalance. Now you can also use premium and discount of the whole impulse move that brought you down there. And if you see that there's liquidity front running a premium and the price has a reason to go to premium, well, that gives you all you need to know. You're trading bullish up into that level. So last but not least is order flow. So I'll move this over here just in case you guys want to keep looking at it. But order flow helps us in not only getting our entries and figuring out, the precise movement of price, but it can also complement our bias in the sense of asking ourselves what order flow is being respected. So what do I mean by that? Well, if we see a market where price is trading up and we take liquidity, right? We see a big push, but we get a nice wick out of there, then price moves up. Well, that would be bullish order flow because you're looking at it like a market maker. Price is digging into sell side liquidity, stopping traders out, oftentimes moving into an order block or an imbalance, and then getting displacement out of there. So if you're taking liquidity on the sell side and you push up away from a price delivery array like an order block or a fair value gap, well, that can tell you that bullish order flow is being respected. I think it's also very important to think like this because it's going to help you understand what is smart money doing. If you see a target in a premium and you continuously see lows getting ran and price rushes back up, you know that smart money is taking out liquidity, taking out stops, and pushing price to their true narrative. So that gives you the why, and it complements your structure and liquidity. So in conclusion, daily bias really is just, are you bullish or bearish? Don't make it more complicated than it needs to be, as a lot of people like to do in this space. But it's really just determining, if I'm coming to my desk in the morning, am I looking more for longs or shorts? Another important takeaway is that you can trade against the bias, but you need to be aware of it. That's it for this video. I hope it helped. Please like and comment and subscribe. It really helps me a ton. And if you want to put down in the comments, any questions you have, you can message me on Twitter, on any social media. I will get back to you. I respond to all DMs. But until the next time, I'll see you guys later. Thanks for making it to the end of the video. If you want access to the private Discord, use code CASPER, all caps, to start your free trial. That's where I provide my trade signals, teach my private classes, and you have access to one of the best trading communities out there. I really appreciate you guys taking the time to watch my content. And if you ever have any questions, feel free to hit me up on any of my social medias. They are all down in the description with the link to Playbit. Have a great day. And remember, if you can't see the liquidity, then you are the liquidity.